quorum. Our second panel is made up of one witness, the CEO of JPMorgan Chase, Mr. Dimon. And Mr. Dimon, you're recognized for 5 minutes, but maybe if the cameras will take a picture and then sort of exit. But all right, Mr. Dimon, you're recognized for 5 minutes, and we welcome you to the committee.
Thank you, Mr. Chairman. Chairman Baucus, Ranking Member Frank, and members of the committee, I'm appearing today to discuss recent losses in a portfolio held by JPMorgan Chase's
Mr. Chairman, could we get him to pull the mic a little bit closer?
Chief Investment Office. These losses have generated considerable attention, and while we are still reviewing the facts, I will explain everything I can to the extent possible. JPMorgan Chase's 6 lines of business provide a broad array of financial products and services to individuals, small and large businesses, governments, and not-for-profits. These include deposit accounts, loans, credit cards, mortgages, capital markets advice, mutual funds, and other investments. Let me start by explaining what the Chief Investment Office does. Like many banks, we have more deposits than loans. At quarter end, we held approximately $1.1 trillion in deposits and $700 billion in loans. CIO, along with our Treasury unit, invests excess cash in a portfolio that includes treasuries, agencies, mortgage-backed securities, high-quality securities, corporate debt, and other domestic and overseas assets. It also serves as an important vehicle for managing the assets and liabilities of the consolidated company. In short, the bulk of CIO's responsibilities is to manage an approximately $350 billion portfolio in a conservative manner. While their primary purpose is to invest excess liabilities and manage long-term interest rate and currency exposure, it also maintains a smaller synthetic credit portfolio whose original intent was to protect or hedge the company against a systemic event like the financial crisis or the current Eurozone situation. So what happened? In December 2011, as part of a firm-wide effort in anticipation of new Basel capital requirements, we instructed CIO to reduce risk-weighted assets and associated risk. To achieve this in the synthetic credit portfolio, the CIO could simply have reduced its existing positions. Instead, starting in mid-January, it embarked on a complex strategy that entailed adding positions that it believed would offset the existing ones. This strategy, however, ended up creating a portfolio that was larger and ultimately resulted in even more complex and hard-to-manage risks. This portfolio morphed into something that, rather than protect the firm, created new and potentially larger risks. As a result, we've let a lot of people down, and we are sorry for it. Now let me turn to what went wrong. We believe this series of events led to the difficulties in the synthetic credit portfolio. These are detailed in my written testimony, but highlight the following. CIO's strategy for reducing the synthetic credit portfolio was poorly conceived and poorly vetted. In hindsight, the traders did not have the requisite understanding of the risk they took. The risk limits for the synthetic credit portfolio should have been specific to the portfolio and much more granular, i.e., only allowing lower limits on each specific risk being taken. CIO, particularly the synthetic credit portfolio, should have gotten more scrutiny from both senior management and the firm-wide risk control function. In response to this incident, we've already taken a number of important actions to guard against a recurrence. We've appointed entirely new leadership for CIO. Importantly, our team has made real progress in aggressively analyzing, managing, and significantly reducing our risk going forward. While this does not reduce the losses already incurred, and does not preclude future losses, it does reduce the probability and magnitude of future losses. We are also conducting an extensive review of this incident, which our Board of Directors is independently overseeing. When we make mistakes, we take them seriously, and often we're our own toughest critic. In the normal course of business, we apply lessons learned to the entire firm, so we can never say we won't make mistakes. In fact, we know we will make mistakes. We do believe this to be an isolated event. We will not make light of these losses, but they should be put into perspective. We will lose some of our shareholders' money, and for that we feel terrible, but no client, customer, or taxpayer money was affected by the incident. Our fortress balance sheet remains intact. As of quarter end, we held $190 billion in equity and well over $30 billion in loan loss reserves. We maintain extremely strong capital ratios, which remain far in excess of regulatory capital standards. As of March 31st, our Basel I Tier 1 common ratio is 10.4%, and our estimated Basel III Tier 1 common ratio is 8.2%, both among the highest in the banking sector. We expect both of these numbers to be higher by the end of the year. All of our lines of business remain profitable and continue to serve consumers and businesses. And while there's still 2 weeks left in our second quarter, we expect our quarter to be solidly profitable. In short, our strong capital position and diversified business model did what they were supposed to do, cushion us against unexpected loss in one area of our business. While this incident is embarrassing, it should not and will not detract our employees from our main mission, to serve clients, consumers, and companies and their communities around the globe. During 2011, JPMorgan raised capital and provided credit of over $1.8 trillion for our consumer and commercial clients, up 18% from the prior year. We provided more than $17 billion of credit to U.S. small businesses, up 52% over the prior year. And over the past 3 years, in the face of significant economic headwinds, we made the decision not to retrench but to step up, as we did with markets in turmoil when we were the only bank willing to commit to lend billions to the states of California, New Jersey, and Illinois. All of these activities come with risk. And just as we remain focused on serving our clients, we also remain focused on managing the risk of our businesses, particularly given today's considerable global economic and financial volatility. Last, I would like to say that in the face of these recent losses, we have come together as a firm, acknowledged our mistakes, and committed ourselves to fixing them. We will learn from this incident, and my conviction is we will emerge from this moment a stronger, smarter, better company. I would also like to speak directly for a moment to our 260,000 employees, many of whom are watching this hearing today. I want all of you to know how proud I am of JPMorgan Chase, the company, and how proud I am of what you do every day for your clients and communities around the world. Thank you. I'd welcome any questions you have.
Thank you, Mr. Dimon. And let me say that the first panel unanimously said that there was that JPMorgan had sufficient capital and that there were no liquidity problems and that depositors' monies, clients' monies were certainly not at risk. So,
Mr. Chairman, a point of order. Are we going to ask the witness to take an oath and testify under oath, or has that process been waived here?
Well, we've never done that. In my mind, I see no reason at this hearing to do what we have not done in several years.
I object to that, sir. Thank you.
All right. Yeah, I see no reason to place this witness under. This is not a criminal proceeding or even a civil proceeding, and he's voluntarily come before us.
Mr. Manzullo. Mr. Manzullo.
And at this time, Mr. Manzullo for 5 minutes.
Thank you, Mr. Chairman, for calling this hearing. Mr. Dimon, on the third to the last paragraph of your written testimony, you've written, all of these activities come with a risk. And just as we have remained focused on serving our clients, we have also remained focused on managing the risk of our business, particularly given today's considerable global economic and financial volatility. I just returned from a conference in Copenhagen with members of the EU Parliament discussing the tremendous crisis going on with the Eurozone countries. The IMF has estimated that the average debt of the 17 Eurozone countries is about 80% of GDP. But in the United States, the debt of this country, which includes state, local, and federal, is 107% of GDP. And my question to you is, what do you think is going to be the bigger story 2 years from now in terms of the health and strength of the financial industry, the trading losses at JPM or the Eurozone?
I mean, I'm sorry I take up so many people's time in this loss, because it is rather not significant in the global scheme of things and the things that you all have to worry about as legislators and what we need to worry about in Europe. Europe is a significant event. I'm far more worried about Europe than I am about this trading position, and I hope the legislators over there can overcome their complications and keep the Eurozone alive.
Can you give us a reading, in your opinion, as to the impact, for example, on the U.S. economy, should the Greeks decide to get out of the Eurozone, go back to the drama, or should the entire Eurozone itself collapse?
You know, unfortunately, as a bank, we have to prepare for all eventualities, so we're not guessing what might happen. I want to make sure we can come forward to our shareholders and communities and say, whatever happens, we can survive and thrive going forward. Greece defaulting alone is not the issue. It's Greece leaving the euro, and the fallout effect of that might be a bank run in Italy and Spain. What we see is they're trying to put firewalls in place to stop that from happening. If I had to guess at the outcome, I think that might work. I think it's important they do that and hold back a crisis, and then they have to go about having a real fiscal treaty among the 17 nations of the euro. So short-term solutions may stop a crisis, but they won't stop. They got to really fix the underlying problems.
Italy has an economy that's 2.5 times that of Ireland, Portugal, and Greece combined. The Italian banks don't have a liquidity problem. They have a big problem with debt. And could you address the impact of debt on nations as it relates to the ability as it relates to liquidity, but more importantly, the overall economy?
The banking, you know, Italy, surprisingly, is actually a very wealthy nation, and they have the wherewithal to meet their debt, but they're having a crisis of confidence, which is damaging that. The banks there own a lot of the sovereign debt. Banking systems don't function very well if the sovereign system is not functioning. I mean, they actually go hand in hand, so you need to fix both to make the whole financial system strong there.
And the reason I ask that is that, as you know, that the EU is our largest trading partner, and your bank is obviously involved in international finance, and it's always important for members to be able to glean from people who are on the inside of seeing that happening. Can you give, I'm not looking for a forecast, but how do you see the Eurozone issue as being resolved?
In Europe, what we see is that the politicians have the will. They want to fix it. They talk about no plan B. There's only one plan, which is to keep the euro alive. I think the way is very hard because you have 17 nations and 17 parliaments. So what our economists think, and a lot of smart people I listen to, that there will be a firewall for Italy and Spain, that you will have growth and austerity plans for the southern nations, and that the 17 nations will come with a fiscal treaty which has more carrots and sticks in it, and that is believable by the world, and that will show long-term progress of getting down the debts of Europe.
Thank you, Mr. Frank, for 5 minutes.
Ms. Dimon, you said that you want there particularly to be smart regulation as opposed to more. The Commodities Futures Trading Commission budget was $200 million for the year. It's been proposed to cut it. The President proposed to raise it to $308. Not, it seems to me a huge sum. Do you think at the level of $180 million you can get smart regulation out of the CFTC?
I have never looked at the CFTC's budgets. I don't know what they need, and so it would really be almost impossible for me to comment on it.
Well, I'm disappointed. By the way, the Appropriations Committee just voted 27-19 not to give them the additional funds. I am surprised because it did seem to me you are well informed about other aspects of what the federal government does or doesn't do, and to talk about smart regulation, but to, in effect, give them a pass on a substantial reduction of the CFTC seems to me to be a mistake. But that's your answer. Next question is the legislation that would remove any application. I understand there's a Volcker Rule debate, but as you know, over and above the Volcker Rule, there are requirements we have put on derivative trading, which you've spoken of somewhat favorably. But there is legislation that would have exempted the transactions in question and any other transactions conducted overseas, not in this country, from the rules about clearing where possible, about transparency. Do you believe that we should enact that and exempt the kinds of activities we're talking about here, even when conducted by an American institution, from these regulations?
So these trades are not exempt from regulations.
No, I'm talking about the regulation, Mr. Dimon. You know what I mean. I'm talking about the specific rules enacted in the financial reform bill that are about to be adopted regarding derivatives, transparency, et cetera. There's a bill, as you know, that would exempt derivative trades overseas. I understand it's over and above the Volcker rule, whether in a bank or not, but there are two sets of rules here. Do you believe, are you supportive of that bill that would exempt these trades from the rules on derivatives that we hope to have in place?
Yes.
Why do you think that they are adequately regulated elsewhere? Why would you not want the American regulators to have an ability to, for instance, transparency and clearing where possible? I thought you were approving of those. Why would we want to exempt these kinds of activities from those rules?
So these trades are visible and regulated by the OCC and the Fed. 60% of these trades were, in fact, cleared. All of them were fully collateralized, so not against rules that cause those things.
Well, if they were already cleared, Mr. Dimon, excuse me, but then they would have met the rule. But it does seem to me there were some problems with this in terms of your knowing about when they happened, about your being uninformed about them or underinformed. But you are in favor of exempting these kinds of trades from any American derivative regulation.
Not any. Prudential they should have, transparency they should have.
The regulation of derivatives. Well, no, the transparency is part of the thing you would be exempted from. There's no legal requirement for transparency other than that. Well, once again, I'm disappointed. Let me ask you, because we have a time issue, you said that you are, because you have a fortress balance sheet, these were not a threat. But what about institutions whose balance sheets are less impregnable? As I said, a couple of chain link, maybe a picket fence or two. Should we have rules, since we don't legislate just for JPMorgan Chase? Is there a danger that this kind of activity in a financial institution, an insured institution, with less of a strong balance sheet might cause some problems?
I don't know, but I think you should all take comfort in the fact that all American banks are better capitalized. The system is far stronger today.
Well, I appreciate that, Mr. Dimon. That wasn't the question I asked. The question is, and we can't assume that's going to be that way forever. And there are some who are resisting the capitalization. So if you were not as well capitalized, would this have had some problems in it that we didn't have because of your balance sheet? I mean, you said you have a fortress balance sheet. That assumes there's something special about the way you are that made us have to worry less. But we can't assume that's going to be the case for every financial institution.
But I also said that we'll be solidly profitable this quarter, so relative to earnings.
That's not the question, Mr. Dimon. Please don't filibuster. But let me ask you now. I'm sorry, Mr. Chairman. I asked specific questions. Mr. Dimon well knows what we're talking about. Let me ask you, did say finally that there would be some clawbacks for compensation. You've also taken some responsibility here. Will the clawbacks for compensation, is your compensation on the table for consideration of clawbacks?
Yeah, so this whole action is being reviewed by the board.
Yours specifically, specific question.
My compensation is 100% up to my board.
Is it under this? Mr. Dimon, you said there are going to be clawbacks for people responsible. Is your compensation in the pot that's going to be considered for that?
They will do what they see is appropriate. I can't tell my board what to do.
Thank you. Mr. Biggert for 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, over here. What went wrong?
Let me explain to the witness, just because little unusual procedure. The Republican side elected to go in order and not to come back up to the top to allow all the members to ask questions. The Democratic members are starting over.
No, well, let me say, Mr. Chairman,
you have every problem.
not entitled with modifications for people who are here and not here. So that's,
Yeah, that's right. Thank you, Ms. Mr. Biggert for 5 minutes.
Thank you. Mr. Dimon, what went wrong with JPMorgan's value at risk model, which is used to estimate losses that occur on a particular trade or in a portfolio? The press has reported that JPMorgan changed its model, which allowed its London traders to take on more risk, and then JPMorgan changed its model again. And then to top it off, this change occurred in January which seemed to be material in nature but was not included in its value at risk model. And the SEC has said that when a public company changes its model, those changes must be disclosed. So why exactly were the risk models changed?
So we have hundreds, maybe thousands of models. They are periodically changed, updated. The intent is usually to make them better. They're constantly trying to be improved. Back in June of the prior year, CIO and an independent model risk group were trying to update and improve a model. It was approved. It was implemented in January. As of April 13th, we had no reason to think it wasn't a better model and didn't better reflect some of the risks that were being taken there. Clearly, when things started to go south several weeks later, we felt that the new model was not better and went back to the old model, which we thought was better. We disclosed that in our 10Q, so we told our shareholders we should when we filed the 10Q on May 10th.
Okay, so it was changed in May 10th, but was there an approval?
There's an independent model review group which approved it, and we have a review taking place. This is one of the things we're going to go through in a lot of detail and make sure we know all the facts exactly as they happened. I should also point out that you don't run trading risk based on one model. There are a lot of other things that should determine your decisions.
Did you think that that was adequate disclosure?
We disclosed what we knew when we knew it.
Okay. So who was responsible for making the change?
It was approved by an independent model review group. But whether it was implemented really well, I don't know. That's still part of the review.
Okay. You don't know who made the change within the company or decided that there needed to be a change?
No, but there are constant changes. People are asking for updates and adjustments, based upon new facts and new history.
Do you think that regulators should have noticed whether there was adequacy in the reporting?
Regulators review periodically models and model changes, and in this case, I wouldn't blame them. If we fail to pick up its inadequacy, I don't think we should expect the regulators to pick it up.
So you don't think that these changes had anything to do with what happened?
I think it may have aggravated what happened. I wouldn't say it was the cause of what happened.
All right. I yield back.
Ms. Waters for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Dimon, I am trying to understand your position relative to Dodd-Frank and a number of other issues. I'm not going to try to use this as a I got you moment, and I don't want you to use this as a way by a time that you can basically just give us a lot of information that we don't need. You said you support 75% of Dodd-Frank, but after your testimony last week and after following your statements and the lobbying of some of the industry over the last 2 years, I really don't know what you really support. When it comes to the most important and substantial elements of Dodd-Frank, I'm afraid that we don't have your support, even when these reforms would actually benefit your firm, your shareholders, and America's taxpayers by preventing another financial crisis. Of the Volcker Rule, in testimony before the Senate last week, you called it unnecessary, and you asserted that some banks, like JPMorgan, should be treated differently under the rule. They should have a higher speed limit. But at the same time, you also conceded that the Volcker Rule may have prevented the recent trading losses in the CIO. Of capital standards, you told the Senate last week that you support higher capital for larger banks, but your chief risk officer has testified here in this committee against a capital surcharge for the largest U.S. banks. And on Title VII derivatives requirements in Dodd-Frank, you say that you want to work with us to implement those reforms, but you work for loopholes through bills here in Congress. So I want to ask a few questions, and this one is simple, yes or no answer. When we think about the losses coming out of the CIO in London, did those losses stay in London? Or did the $30 billion or more drop in your market value impact your shareholders here in the U.S.?
Yes, it did affect our shareholders, yes.
But you have lobbied very strongly, and you just answered, Mr. Frank, you do believe that the foreign markets should be exempt from the extraterritorial regulations that we're proposing here. And if this impacted your shareholders here, why do you continue to take that position?
I think I said overseas operations are regulated by the Fed and the OCC. These things went to clearinghouse, they collateralized. The reason we are careful about overseas competition, if JPMorgan overseas operates under a different rule than our foreign competitors, we can no longer provide the best products and services to our U.S. clients or our foreign clients. That's why we're concerned about extraterritoriality. It's not about the protection, it's about the ability for us to compete. And when we compete, we give our clients, which include major U.S. companies, better deals. They will go elsewhere if we can't give them the best possible deal, no matter how much they like us.
So you take that position despite the fact that the losses do not stay in London?
Yes.
And you continue to lobby against for exemptions for the foreign trades in out of London?
Lobbying is a constitutional right, and we have the right to have our voice heard.
Oh, well, I'm not questioning your right to lobby. I'm questioning what's in the best interest of the American public. While the public doesn't know the full details of this trade, it is clear that these trades were not subject to the full panoply of rules we crafted under Title VII, and I think we all need to be just very, very clear about that. And I want to know whether or not you are aware of Mr. Gensler's testimony here today and what he said about the risk that you take in not having that kind of exemption, and whether or not you agree with Mr. Gensler and what he testified here today in any way, any shape, form, or fashion.
I don't agree with him. I heard part of it, and I think the starting point should be that the United States is the best, widest, deepest, most transparent capital markets in the world that had flaws. We should fix the flaws. We're concerned about some of these things making us not the best capital markets in the world. And the best capital markets in the world are part of what made this the best business machine ever, the United States of America. So we just want to get it right. It's not binary. It's not one thing. These are very complex rules. We want to get it right so that it works for America.
Thank you. Mr. Duffy, 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, good morning. I think it's clear that we're not here because a private firm lost $2 billion. I think it's clear that we're here that many of the American taxpayers are concerned when big banks go bad, they're left holding the loss. It's one of these philosophies where we have capitalism on the way up, where you and your firm make a lot of money when you do well, and when you fail, we have socialism on the way down, and the taxpayers bear the brunt of that loss. And that's why we sit here today, to make sure that taxpayers in Wisconsin don't bear the loss of big banks on Wall Street. And so when we look at what's going on, I mean, would you say that the regulators are capable of sufficiently regulating a bank the size of JPMorgan?
First of all, I completely agree with the fact that taxpayers should never pay for a big bank failing. Totally. And so we should work on things and make sure that's true, and we give people
But you'd agree we're a little nervous about it when we had TARP and the taxpayers did it just a couple years ago. We're a little gun-shy with big bank losses.
Right.
And so are the regulators sufficiently staged to regulate a bank the size of JPMorgan?
I think the regulators have been challenged with a lot of new rules and regulations. I think it's challenging them to get them all done on time.
Can they regulate a bank the size of JPMorgan?
I believe they can, yes.
And so I want to be clear on this, because per your testimony, you've said one of the best and brightest CEOs in this industry, held out in high esteem. You didn't know about these trades. You didn't know about these losses. How do you come forward today and say the regulators should have known that what one of the best CEOs in the industry didn't know and couldn't have known?
I didn't say that. Remember, we have higher capital standards, higher liquidity standards, far more rules. Most banks are stronger. There's far more, boards are more engaged, risk management committees are engaged. There's no off-balance sheet vehicles. There's no more subprime mortgages. The system is far healthier, and you got to look at regulation in its whole, not just the one thing that they might have missed.
But if one of the best CEOs in the industry doesn't know about these trades, how can we expect the regulators to know about these trades and protect the American taxpayer?
I think it would be an unrealistic expectation that they're going to capture everything. Some things will get through their screen, like some things get through our screen. However, they can make it a better system by disseminating that kind of information to a lot of other companies. They audit us regularly. They constantly are criticizing some of the things we're doing. It makes us a better company. I just think we need realistic expectations for regulators.
And I would agree. But is it fair to say that a $2.3 trillion bank is too big to manage, too big to regulate, too big to control? It's just too complex? I mean, are you too big to fail?
No, we're not too big to fail. We believe that a bank should be bankruptable, and that when a bank fails, that the clawback should be invoked on equity, on management. The board should be fired. The company should be slowly dismantled.
And who pays the losses?
In a way that doesn't cost the economy anything.
Who pays the losses?
Ms. Duffy, allow the witness to answer
that
the
should be
question.
charged back to the other big banks to survive. That's what I believe.
If JPMorgan fails, who picks up the tab?
If JPMorgan fails, I don't think anyone's going to pick up any tab because we have $190 billion of equity, $290 billion of unsecured debt. So I don't think there's any chance we're going to fail. But if we did, any losses the government would bear should go back, be charged to the banks, just like FDIC today is charged back to banks. So we have JPMorgan is going to spend $5 billion of fees to the FDIC to pay for the failure of other banks.
So we have the order.
I don't like the $5 billion, but I think it's appropriate that the American taxpayer doesn't pay for that guarantee.
I didn't mean to interrupt him. I thought you were done. Sorry. Well, the orderly liquidation authority would step in and bear the brunt of JPMorgan's loss should you fail, right? That's the way Dodd-Frank is.
The loss would mostly be borne by equity and unsecured debt. They might provide temporary funds to keep the company functioning in the short run.
Okay, but is it fair to say that JPMorgan could have losses of $500 billion or $1 trillion?
Not unless this Earth is hit by a moon.
Okay. Want to go to your trades that brought us brought you the $2 trillion, the $2 billion to $5 billion loss. The dollars that were used to trade, those were dollars that were backed up by the FDIC. Is that right?
Excuse me. I'm sorry. Say it again.
The $2 to $5 billion loss that you incurred, the dollars that were used to make those trades, those were dollars that were backed up by the FDIC?
Yes.
Okay. And why then weren't you taking this excess deposit and investing those dollars here with American businesses, American consumers, instead taking those excess dollars backed up by the American taxpayers or the FDIC and sending them over to London to make very complex trades?
It's not either or. We have $700 billion of loans. We've got $200 billion of short-term investments in central banks around the world to handle cash flows for our clients. And we've got a $350 billion AA plus securities portfolio. Any valid loan that comes in the door that we can make, small business, middle market, where we are, we try to make those loans. Like
Thank
I said,
you.
small
Thank you. Maloney, and let me say, I'm sure somewhere in Dodd-Frank there's a prohibition against a moon strike of the earth. So, Ms. Maloney.
Thank you. I would like to welcome Mr. Dimon, who resides in the district that I am privileged to represent. And I would like to note that he has been a major employer in a number of different financial institutions before joining JPMorgan Chase. I would like to ask you, Mr. Dimon, I always thought that you loved New York. So why are all these jobs and all this activity taking place in London? And I specifically would like to know, why were the losses incurred in the London unit? They didn't take place in the New York unit. And could they have incurred in New York just as easily? We learned in the prior regulatory panel that a substantial portion of the bank's chief investment office's activities, including its credit derivatives trading, are conducted through the London branch, and that other large financial institutions likewise have London offices. And I certainly understand that we're in a global market and we have to be in global markets and around the world. But what is it about the regulatory regime in the United Kingdom that encourages such a large portion of these activities to take place in London as opposed to the United States. And I would also say that a large portion of the credit disasters have taken place in London. AIG, we bailed out at $184 billion, Lehman, UBS, there's a whole series. And I want to understand why all this is taking place, why London?
The predominant part of CIO is done in New York, but we operate in 100 countries. We're on the ground in 60 countries. We take deposits in a lot of those countries. We have to invest in some of those countries. They all have their own laws, rules, and requirements. And it could have, that operation could have been in London or somewhere else. Sometimes the operations are where we have the people. So,
is the regulatory regime lighter in London? Why is all the activity overwhelmingly and all the problems appear to be in London?
I don't think this activity was in London because regulatory activity was less in London. And most that we do out of London is serving European companies.
Well, what are the lessons that you have learned for large financial institutions going forward? Is there any way to ensure against this type of loss where a trader is forced to hedge the hedge and cover losses that led to more losses? Is it possible to ensure that legitimate hedges never morph into something else?
It's not possible to ensure we'll never make a mistake. Anyone who's ever been in business knows you make mistakes. Hopefully they're small. Hopefully they're few and far between. And hopefully they're not life-threatening, which this is not life-threatening. And, you know, we, in this one area, we failed to have the granular limits and the rigorous review that we should have. We believe that's not true for the rest of the company. We try to be very, very disciplined, and we fixed this problem the second we found it.
And were the risk limit rules raised while the loss-making position was on the books?
No, sometimes limits are hit or triggers, and it asks you for further focus and detail, and I think some of the things you heard about were when some of these limits were hit, people did what they were supposed to do.
So did they raise them?
They do get raised sometimes, yes.
And why? Because it said in, why were they raised again?
I didn't say they were, I don't know if they were raised, but I'm saying it is sometimes they do get raised.
So you don't know whether they were raised or not?
They might have been, I don't recall it specifically.
And was the loss-making position increased in size after it began generating losses?
What I recall is that they weren't really increased in size after early April. That at one point they stopped taking positions, and I think that was late March.
And what was the delay between the start of the losses and senior management action?
So prior to April 13th, there had been some losses. Management was looking at it. People looked at stress testing. A lot of folks thought it was an aberrational thing that would come back, which happens sometimes. The real losses started later in April, like late April, like the last week of April. At that point, we brought in some top experts again. They dug deep, and we realized we had a much more severe problem. And there so it was late April that we started to realize how bad it was.
And what was the delay between the start of the losses and disclosure of the losses to the Office of the Comptroller of the Currency on site at JPMorgan Chase?
I don't believe there's a delay in the disclosure of the losses. We run a regulatory, we try to run the company that we're what I call open kimono to the regulators. We tell them what we know and when we know it. I don't know exactly what all the reports they're looking at, but we don't hide reports from them. They do see P&L, so they saw the losses. I do know at one point our CEO went to see them to explain what had happened right prior to April 13th. We did not understand the seriousness of it until later in April. On April 13th,
Thank you, Mr. Schweiker.
The time has expired.
5 minutes.
Thank you, Mr. Chairman. And forgive me as I've been bouncing around. Just so I can get my put it on the record, what's the best model estimate of what the loss is?
we have not disclosed that because when we make disclosures to shareholders, we're going to disclose the quarter on July 13th. At that point, we're going to give a full and fair explanation of what went on. I personally, feel that this will never be life-threatening to the company, and we're going to have a solidly profitable quarter. and more details to come when we report the quarter.
Then, Mr. Chairman, Mr. Dimon, then probably the second
And
question.
I will reserve your time, so if we stop the clock. I think we all need to realize, and I think if you've read the articles on this, the more disclosure that is made, the more those betting against the position of JPMorgan can use that to the disadvantage of JPMorgan. In fact, I think it's pretty well established that part of this open disclosure and discussion has allowed a lot of those, has precipitated some of those losses. But it's not necessary for him to disclose proprietary information. Yeah, but I think if you read any of these articles, you see that they're managing this. And independent people have said but the loss could be $6 billion, but that's just an estimate. It could be $2 billion. It could be, some have estimated it could be less than that.
Thank you, Mr. Chairman. And
start the clock.
Being respectful that you'll be doing your quarterlies very shortly. So the second question I was going to ask is, profit for the quarter, but I guess we'll just wait on that one too.
But there will be profits in the quarter.
Yeah, and that was basically the point I was trying to head towards, is that at least as an institution, this is, it's not happy, it's shareholders' money, but not devastating.
Not devastating. Not fun either.
And this is actually more of an offshoot, having read over some of the Senate testimony. I want to get my head around something that's actually all up and down both the financial, the fixed income, and the banking community. We're all operating in an environment that literally is zero interest rates. You plug in interest rates today and plug in what real inflation. So slight movements, whether it be caused by a cascade in Europe or Argentina or some Fed policy or fiscal policy here. My understanding is just little bits of movement would be devastating to your book of business if you have not hedged that. What scale are you hedged for the fear of movements in interest rates, a couple ticks up?
Right. So our biggest exposures are credit and interest rates. And we try to manage the portfolio and all our interest rates such that rising rates don't hurt us, because our biggest, what I call fat tail risk, is you have rapidly rising rates. In fact, we're positioned today that if rates went up, we'd make more money. And that does cost us to do that.
But you're heading towards the ultimate question here. I'm trying to get a sense of the cost to prevent, to do that type of risk management. And that's one of the frustrations. I hear lots of discussion going on about, are you doing risk management here? But a lot of folks don't understand, it's expensive.
It's expensive, yeah. I'm guessing now, but it costs us probably over $1 billion a year to be positioned where we are to benefit from rising rates as opposed to neutral to rising rates. But I think it protects our company, which is why we're there.
So
again, we may be wrong.
And do you have to do excessive amounts of hedging in that fashion, or buying, we'll call it interest rate insurance? It might be an easier way to understand it, because of your imbalance in both deposits to loan portfolio?
Yeah. So the investment portfolio is invested to help manage that exposure, which is why it's invested what I call shorter than most. The average maturity or duration is 3 years. If you invest that longer, you can earn more money. Having it shorter is more conservative. It gives us the ability to reinvest like $40 billion a year at whatever the new current rates are. So that portfolio is one of the main things we use to manage interest rate exposure.
So when you do that, so your universal WAM is what? You were just saying 3 years?
The duration is 3 years of the AFS portfolio, the $350 billion portfolio.
And that costs you almost $1 billion a year just to insure?
Just to keep it positioned so that we benefit from rising rates.
In this type of environment, and your understanding, and I know we're still all working on what the ultimate mechanics, Volcker rule. What would have happened in these trades if the Volcker rule was fully implemented as you understand it?
So the Volcker rule specifically allows portfolio hedging. And I think what we initially, the original intent, it would have been allowed because it was a hedge that would benefit the company in a terrible stress like Eurozone. I think what it morphed into, I cannot defend. It violated common sense, and I don't know if the Volcker rule could have or would have stopped that. If it did, it wouldn't bother me. I wouldn't be sitting here. I think the far more important thing about the Volcker rule is the ability to make active markets here, which keep down spreads for everybody, for all investors, and that makes it easier for companies to raise money and cheaper for investors to invest money. And those investors are veterans, retirees, mothers. They are not just people like me. So that's why we think the Volcker rules have to be written very carefully to maintain the best capital markets in the world and not stifle them.
Okay, in 6 seconds, how do you as a international organization hedge against political risk? What's happening in Argentina? What's happening in Europe? What's happening in other places? What do you have to do, and what does it cost?
Well, some places we don't do that much business in, so it's obviously an easy solution. In other places, you have conversations with the board about if you are wrong about a country, how much you might be willing to lose. So we do investments in certain countries, but we don't want any one country or anything to damage JPMorgan if we're wrong about our view about that country.
Thank you,
Thank you,
Mr.
Thank you, Mr. Chairman.
Thank you. Ms. Velasquez for 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, although these trading laws did not do substantial harm to Morgan Chase capital position, it very well may have caused the collapse of a weaker bank. Do you think separating similar investment activities from traditional banking, taking deposits and making loans, is a reasonable approach to protecting the fragile economy from bank failures?
I do not. If you look at most of the failures...
I thought so.
If you look, well, let me give you some facts to support what I say. Early on, mortgage bankers went bankrupt, monoline investment banks, Bear Stearns and Lehman, a monoline insurance company, AIG, WAMU and IndyMac, which were monoline thrift kind of savings companies, Fannie Mae and Freddie Mac, which are the biggest financial disasters of all time, were monoline mortgage insurance type companies. All of that happened and had nothing to do with Glass-Steagall. And in other parts of the world that didn't have Glass-Steagall, like Canada, they didn't have any problem at all because they had good banks, good regulations, and proper capital levels, et cetera.
Okay, so as you know, the rulemaking to implement the Volcker rule is ongoing, and experts are still debating whether, in its current draft, the rule would have prohibited these trades. How should, given the lessons learned, the Volcker rule be implemented to account for the complexity of trades like those that caused JPMorgan loss and the possibility that they move beyond purely hedging risk?
Look, I'm not writing the rules. That's other people's jobs. But I think I said it was a strategy that was badly vetted, badly implemented, badly tested. And I would ask companies, if you're going to do something like that, properly vet it, properly test it, so that it never morphs into something which isn't what it was really intended to do.
So, you know, the dilemma is, where does the hedging risk stop and risky proprietary trading start?
I can't define that for you. I'm sorry.
Thank you, Mr. Chairman.
Thank you. Mr. Grimm for 5 minutes.
Thank you, Chairman. Good afternoon, Mr. Dimon. Can we, just to continue with, we're hearing a lot about this Volcker rule. We heard before from Ms. Waters that if all of Dodd-Frank was implemented, it's possible that these trades wouldn't have occurred. Would it be safe to say that if you didn't do any trading at all, you wouldn't have any losses? Is that true?
Yes.
So if we made banks a utility and we couldn't compete with Europe, that would pretty much clear this up as well. Would that be one way to get rid of losses and take all the risk out?
Yes, I think.
Okay. So when we look at, before we were talking about the regulators, and my colleague, Mr. Duffy, was saying, he asked you, do you think the regulators can regulate JPMorgan Chase? You said yes. And his argument was, why couldn't they find this one trade? I think the point, again, my humble opinion, regulators are there to look overall at the major rules, such as maybe minimum capital requirements, maximum leverage ratios, maybe some concentration risk, some rules in place for you're not too concentrated in one area. And those three things combined, regardless of whether you have a bad trading day, is it safe to say that we could never expect regulators to be able to have foreseen this loss of JPMorgan Chase?
Yeah, and I think it's fair to say that regulators do the job. The system will be healthier. Most banks will be healthier, and the chance of having a systemic collapse should be virtually zero.
Okay, then would you agree?
But to expect them to capture any one trade, I just think is an unrealistic expectation.
Okay, well, I happen to agree with that. I don't think regulators will ever be set up to do that for the amount of institutions and the amount of trading and the amount of metrics that would need to be put in place to figure out whether something is a prop trade or not is an unrealistic goal, and we're setting ourselves up for failure. And I think if we focus, and I want to ask you a question, if we focus on things like the capital requirements, leverage ratios, making sure there's not too much concentration, I think that's something that regulators can actually get their hands around and do a good job at. Would you agree with that?
Yes.
Okay. Now, if I can get into the weeds a little bit, just to understand a little bit about your risk models without divulging your proprietary information, can I just ask, what was your value at risk model? How did you calculate it? Was it daily, weekly, monthly?
I believe it to be daily.
Daily. Was it? Do you know if it was a 95% concentration? 95% confidence?
I think we look at both 95 and 99. I forget what the public disclosures are.
Okay, because my question was going to be, a 95% confidence level is approximately 2 standard deviations. If you go to 3, 4 sigma, you're talking 98, 99. Would that have helped your scenario? Or I'm just curious, would that have actually helped?
So VAR is just a basic statistical thing that shows how much volatility there is in a security or basket of securities. There's nothing mystical about VAR. The other things which normally help is having limits at a very granular level and doing what I would call real stress testing. Like what happens if rates blow out, what happens if credit spreads blow out, what happens if the Eurozone has a crisis, what happens if you have a credit crisis in the United States. So we do all of these serious things to manage risk. VAR is one measure, and in my opinion, not the best of them either.
Okay, and I want to also go back to make a point. At any point, I know the sums were technically insured by FDIC, but at any point, even now, having the benefit of looked at these trades, were the taxpayers at risk?
No. And I believe one of the Fed governors here is saying that the bank can bear $80 billion of risk before the taxpayer might be at risk.
And lastly, I just want to, because I'm actually trying to get my hands around this to look at some areas of concentration risk, because we hear a lot about what I think we're doing is trying to turn banks into utilities, and I think there are better ways to do it, and maybe looking at concentration risk. When the financial meltdown in 2008, much of the concentration was in loans. We know it was in subprime. Based on JPMorgan's size, just your size alone, other market positions were able to clearly notice your London desk's activity related to somewhat illiquid credit indexes. Do you think reevaluating your concentration risk, especially in light of things that are liquid, is something that makes sense for the banking institutions as overall, besides just JPMorgan?
Yeah, that was one of the flaws here. In this book, we should have had more granular limits. I didn't mention them specifically, but one would have been specific limits on anything that might be illiquid, specific limits on credit, specific limits on counterparties. We had some, but not all, and they all should have been in place.
Thank you, and I yield back.
Thank you. Mr. Ackerman for 5 minutes.
Thank you. If I might, I'd like to get back to some very basic concepts. In your opinion, is gambling investing?
No. No, it is not.
What's the difference between gambling, briefly if you could?
I think when you gamble, on average, you lose. The house wins.
That's been my experience with investing. But that's a...
I'd be happy to get you a better investment advisor and see if we can improve upon your experience.
You have, in general, except for recently, an excellent track record. I would tend to agree with you, but we seem to be treating them quite the same. I used to think that all of Wall Street was on the level, that it facilitated investing, that it allowed people and institutions to put their money into something that they believed in and believed would be helpful and beneficial and grow and make money and especially help the economy and on the side create a lot of jobs and be good for our country and good for America. Now a lot of what we're doing with this hedging and you could call it protecting your investment or whatever, but it's basically gambling. You're just betting that you might have been wrong. It doesn't help anything succeed anymore, doesn't encourage anything anymore. It creates the possibility that people are saying, do these guys really know what they're doing if they're now betting against their initial bet? And then if you go and hedge against your hedge, which means you're betting against your bet against your first bet, it seems to me that you're throwing darts at a dartboard and putting a lot of money at risk just in case you were wrong the first time. I don't see how that creates one job in America. I don't see how it helps the American economy. I don't see how it helps the housing market or the building market or the let's make steel or widgets market. 1/10 of a zillionth of a percent. What it helps is if you were right a majority of the time, then it makes a bunch of money for the guys who did it and doesn't help the company, the industry, the economy, or the country at all. And if you were wrong, it puts systemically everything at risk. And when I say everything, I mean the confidence that the American people, the public, the investing community, and everybody else has in the system. And that's a loss you can't hedge against, because the more you hedge, the more questions you raise in the confidence of what you're doing with your initial investment. And the fact that you've chosen to do this overseas raises a lot of fuzziness. And maybe the business is there, and it's not illegal to do it over there. It's just as good to do it over here. And, you know, when you come back from an overseas trip at customs, there's always a question on the form, did you have any exposure to farm animals? And I'm sure the nice people over in Europe and Africa and Asia, they have safety codes and enforce them, but they still ask the question because they're worried about the infiltration of the problem into the American system and putting us at risk. They ask that question. How is this hedging and wedging thing any different than protecting yourself by taking the odds to Las Vegas?
We don't gamble. We do make mistakes. The main mission of this company is to serve clients around the world.
But
last quarter, we did $40 billion of mortgages. I assume you want us to do that. We're the biggest one of the biggest small business lenders in the United States. We raised $400 or $500 billion for the biggest American corporations. We bank some of those corporations in 20 countries around the world. Our main mission is serving those clients, investors, capital issuers, small businesses, and consumers. That's what we do.
Granted, but when you
we lost $2 billion on Chrysler. I assume you want us to continue to lend to Chrysler.
I want all good things to happen. But wouldn't you be serving those clients better? And you've done a pretty adequate job from what I could see. Wouldn't you be serving them better if you spent more time and energy or that $1 billion in figuring out all these mathematical formulas? Wouldn't you do a better job if you evaluated the investment a lot clearer with another $1 billion into that?
In this case, yes.
Well, why shouldn't we apply that to the whole program? I mean, you know, what I'm doing is I'm raising a question on what is the purpose of hedging. If you're right, you win. If you're wrong, the system loses. We all lose in that confidence. There's nothing more important to that confidence.
Thank you. Thank you. Mr. Fitzpatrick.
Thank you, Mr. Chairman. Much of the discussion regarding JPMorgan's trading losses focused on whether the activity in question would have been prohibited if the so-called Volcker Rule had been in effect. What's your view on that?
I've already said I don't know. The Volcker Rule isn't fully vetted yet. It's not fully written, and I just don't know. The Volcker Rule specifically allows portfolio hedging, properly done. You know, if properly vetted what this wasn't really that. So if it does or didn't prohibit, it wouldn't bother me.
Putting aside the question whether it would have been prohibited under the Volcker Rule, since the regulators who wrote it can't seem to answer that question either, what's your view on whether it should be prohibited?
I believe that portfolio hedging properly done should be allowed. It protects the companies, and particularly in times of dramatic credit crisis or Eurozone crisis, etc. So I do believe it should be allowed. Portfolio hedging.
Mr. Dimon, some have suggested that your position as a board member on the New York Federal Reserve Board is a significant conflict of interest, and have suggested that you and other bankers who sit on the board should resign your positions. How do you respond to that?
So the Federal Reserve rules are written by you all, and so, but I should tell you that I don't vote for the president. I don't get involved in supervisory. I can't serve in the audit committee. The board basically sits around and talks about the economy, what's going on. There are 12 Federal Reserve boards. That information, I think, is put together and sent to Washington. It's more of an informational advisory group, and whatever the lawmakers write would be fine with me. I personally, if I had a board, I'd want to hear from a lot of different types of people. It'd be funny to have talking about global markets and not have someone involved in the global markets at the table. It certainly does not have to be me.
Nothing further.
Mr. Sherman for 5 minutes.
Thank you. Mr. Lynch wanted to swear you in. You've already said something that is false, that we all know is false.
Let me.
Excuse me. Let me finish.
Sir, I want to clarify something about swearing people in. We had a hearing in September of 2009 where Mr. Frank was chairman, and Mr. Frank made a decision not to swear in any of the CEOs of the banks about what had gone on in September of 2009. I am following the protocol of the committee. If you want to continue to say he ought to be sworn in, that's fine.
I wasn't saying that, Mr. Chairman. I was not criticizing you. But if I can't get to the end of the sentence.
I'm saying that the ranking member has said I'm doing something unusual here. What I'm doing is following the standard policy.
Oh, excuse me, Mr. Chairman. I didn't say you were doing anything unusual.
Well, I took it as saying.
What? I didn't. I made no comment.
I'm sorry. I guess that's right. I think it was Mr. Lynch.
Not everybody from Boston talks the same.
That's right.
But let me just say.
I think we should swear ourselves in.
This is normal, standard operation.
Mr. Chairman, I do want to take exception. I have made no comment on the swearing in. Let me just, if I could, just another 30 seconds. I am gratified that you are following my precedent, and I will have by tomorrow another list of precedents that you can also follow, and we'd all benefit.
Well, don't get in any rush to give it to me.
Mr. ʻdaɪmən, had you been sworn in, you would face no legal liability for the comment that I think you've made that is erroneous, because we here are here because we're in touch with Main Street in our district. And you put forward the idea that that there were $350 billion that you had given to your chief investment office because there weren't small and medium-sized businesses in the United States that were creditworthy that wanted the money. And I assure you, there isn't a member of this panel that couldn't bring you 100 small and medium-sized businesses, creditworthy, in need of loans from you. And instead, you took the $350 million to London. And that's why we're here, because if you'd made the small and medium-sized business loans, you wouldn't be here. And some of that money in London went to the gambling tables in London. And whether it was $2 billion lost or some multiple of that, that's why we're here. And I would hope that you would leave here dedicated to taking the money away from your London operations and lending it to small and medium-sized businesses. And if you can't find 100 in each one of our districts, we'll do it for you. Now, I'd like to, without objection, put in the record an editorial by the wild socialists over at Bloomberg. I assume there's no objection.
Without objection.
They point to a study just published by the IMF that says that your bank enjoys a $14 billion subsidy, that its cost of funds is some 0.8% lower because of the implicit federal guarantee. What we saw in 2008 is a belief around the world that if a bank your size was going to go under, there would be a bailout not just of insured depositors, but of all creditors. And that belief reduces your costs by 0.8% of your total funds, is responsible for $14 billion you are in a position where you are simply too big to fail. And this raises, and I think the gentleman from Wisconsin made this point. You lost $2 billion, according, or some multiple of that. You happen to be very well financed, but you bet over $300 billion. You're lucky that you know, and fortunate and wise that you didn't lose more. Can you say on behalf of all the banks with over $100 billion in assets that all of them could have survived a mistake this size? I'll ask you to answer that for the record. The question is, why should we allow you to be so big that if you go under, we are going to have to bail out your creditors?
So banks should take risks relative to their size and capability, so you can't compare all the banks. And I would venture, and I'm not going to change what you believe, but a lot of banks were a port in the storm. I know it's convenient to blame them all for everything, but JPMorgan's size and capability and diversification in 08, 09, and 2010 allowed us to continue to do the things that you wanted us to do. We never stopped making loans. We bought Bear Stearns at the request of the United States government. We helped the FDIC fund by buying WAMU. We lent money to California, New Jersey. It allowed us to do it. So we try to be a conservative company that does the right thing. Every now and then we make mistakes.
And how can medium-sized banks compete against you when your cost of capital is reduced by 80 basis points, 0.8%, because of a belief that if they go under, we'll let them go under, but if you go under, we'll bail out your creditors?
And I don't believe that's true. I'm going to give you two facts, if you don't mind. Fact number one is we borrow in the marketplace, unsecured, with the smartest people in the world. It costs us 200 basis points over Treasury. It costs the average single-A industrial like 100 basis points over Treasury. So we are, if everyone was so smart and knew that we were too big to fail, we'd be trained at 10 basis points over Treasury.
Well, after you lost all that money in London, I would expect that creditors would be reluctant to lend you money at less than that rate.
Most of that $350 billion predominantly is in the United States. It's not in London. Most of it's here. The second is the FDIC report, which looks at average funding costs, because we had studied this report a way back, and almost all of it, if I remember correctly, was related to mix. We're a money center bank. We have a tremendous sum of money, which we keep very short-term and overnight, which costs us very little right now because of the way the yield curve is. But we have to put out, we're the checking account for large corporations, including some nations, and so we invest that money very short and make almost no money on it. It shows up as a low funding cost, but our actual cost of funds for retail deposits, middle market deposits, and negotiated deposits is probably pretty much like everybody else.
There isn't a small or medium-sized banker who agrees with you.
Mr. Canseco, for 5 minutes.
Thank you, Mr. Chairman. I've spent a number of years in the banking sector, and I'm approaching this hearing keeping in mind a primary truth about the banking industry, and that is that the business of banking is inherently risky. Lending money is a risky proposition. This was evident back in February when your firm disclosed in an investor presentation that it had set aside $27 billion, more than 10 times the amount of its recent trading losses, in loss reserves against its loan portfolio, providing that lending and exposure to credit was and is the largest risk facing America's banks today. So we must keep this in mind as today's hearing has focused on whether it's appropriate or not, Volcker Rule, and the attempt to keep banks from making so-called risky investments. Yet in the years leading up to the financial crisis, there was hardly a riskier proposition than extending mortgage loans in the midst of an artificially inflated housing bubble. And if you want further proof of this, look no further than Fannie and Freddie, who didn't need to make proprietary trades with depositors' funds in order to lose $200 billion of taxpayer money. The irony is, of course, that had the Volcker Rule been in effect prior to the crisis, it's likely that banks would have had even more exposure to the housing bubble, and the crisis would have been far deeper and far worse. Someone once said that, like energy, risk is not created or destroyed, it is simply transferred, passed on. And I feel the push for ever more regulation in our economy represents a continued misunderstanding of our banking system and the roots of the financial crisis, and that this misunderstanding is by itself a great risk to our financial system and economy as we move forward. So, with that said, Mr. Dimon, during your testimony in the Senate last week, you stated that we don't actually know who has jurisdiction over many issues we deal with anymore. Did Congress miss an opportunity with Dodd-Frank to simplify our regulatory structure and put an end to regulators passing the buck to one another?
It would have been my preference that we simplify it and we made it a little more complicated, yes.
Thank you. So how do you respond to those that cite JPMorgan's recent trading loss as evidence that JPMorgan and other banks are simply too large and complex to manage?
You know, there are huge benefits to size, and you see them in the kinds of scale and aircraft and banking and diversification. I've already mentioned that we were port in the storm because of our size and diversity. The benefit of size has got to eventually accrue to clients, not to us. That is the capitalist system, that you do things better, faster, and the client benefits. There are some negatives to size. And, you know, if your lack of attention to detail, et cetera. So some of those lack of benefits of size happen to small firms too. And you got to weigh and balance. I think on balance, the company's done a good job for its clients and its shareholders, and we continue to grow and expand. And away from this problem, our businesses are healthy and strong and serving more and more people, both in the United States and around the world. And we're helping a lot of American corporations travel around the world, help them do a better job where they want to do business and do more exports.
So, Mr. Dimon, if the activities of the Chief Investment Officer at JPMorgan were severely restricted under the Volcker Rule, especially to the point where portfolio hedging was disallowed, what would that do to the risk profile of the CIO portfolio?
We would probably just modify the risk profile a little bit of the CIO portfolio and, you know, try to make sure we're not taking undue risks. As I mentioned before, the AFS portfolio has an $8 billion unrealized profit. It's AA+ average rating, and it's invested rather shorter term, not short, but shorter term to protect us from rapidly rising interest rates. So I'd call it a fairly conservative portfolio, and maybe would have changed the nature of it a little bit.
As I understand, the CIA portfolio is around $400 billion of excess deposits that have not been lent out. Is that correct?
350 billion, yes.
It seems to me that if activities were restricted, JPMorgan would be left with the unappealing option of lowering underwriting standards or increasing risk somehow in the portfolio. Is that a fair assumption?
It's possible, yes.
All right. So would you say that if the Volcker Rule were implemented, it's likely that overall risk, the financial system would actually be increased?
I would love to answer the question. I don't know the answer to that. Remember, it's one rule out of hundreds that are all being done together, so I can't tell you the cumulative effect of all of them.
All right.
Thank you. Thank you, Mr.
Thank you, Mr. Meeks. I'm sorry. Thank you. Mr. Meeks for 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, I've been listening, and I think there's another reason why you're here. Some of it has to deal with the fact that, some of it has to deal with politics, to be quite honest with you. Some feel that Dodd-Frank has a role, and others feel Dodd-Frank doesn't have a role. Some think regulations, others think no regulations. I think that we was at a point where we were talking about a lot of deregulations at one point, when I first came to Congress anyways, and we got into the problem that we're in. We were about to, I remember the Secretary of the Treasury coming and saying disaster was about to happen. And so Dodd-Frank came into existence because we wanted to fix the problem so that we would not be where we were when we had this terrible catastrophe that was facing our country. And during that debate, and I want to pick up someplace around where I think Representative Maloney was talking about, there was concern and about a lot of individuals doing business in London, and that's been some of the questions that's been taking place. And I understand that we've got to get the best deal for your investors, et cetera, that. But I kept hearing about this London loophole. And from what I heard you answering to Representative Maloney, that there is no London loophole that wasn't due to any regulations or lack of regulations in London. Yet, when I talked to not to you, but a number of other financial institutions, I'm from New York also, and I talked to them, and they tell me that if we put certain regulations in place, they'll leave New York and they'll go to London because they'll have less regulations in London. So I don't understand if, you know, isn't there something, there's some kind of loophole in London that other institutions, maybe not JPMorgan Chase, but they say that if we put these regulations in place, they will leave New York and take those jobs with them, that's what they tell me, to London. Why is that if there's no London loophole?
So our problem has nothing to do with, as far as I know, any loopholes relating to London or regulate. It could have happened in New York. So that's a separate issue. If a U.S. company calls up JPMorgan and says, make me a bid on an interest rate swap, and we can't give them the best deal, and they're going to get the best deal out of Deutsche Bank in Europe, that's where they're going to go. The rules at the transaction level about margin, reporting, all those requirements may enable Deutsche Bank to make them a better deal. Two things will happen. Caterpillar or whoever the big company is will get less bids. It won't be good for an American company. And the business will move to another bank overseas. You would see some, I don't know the headcount numbers, some firms, if they can, put some people overseas to do the business in foreign subsidiaries with the same company that they were doing it with in U.S. If a U.S. bank can't do the business at all, because the rules are written so broadly that then we will lose a lot of business. You'll lose a lot of jobs here. They will not move to London. But I assure you, they will one day be in Singapore, China, and other parts of the world.
Let me, time is so short. Last week you referred to big dumb banks. In your opinion, could a big dumb bank be successfully resolved under Title II of the Dodd-Frank Act without harming the American economy?
Yes, but we all have work to do to harmonize that globally and get the exact rules in place, things that you all call living rules and resolution, et cetera. But yes, I believe it can be done. More work needs to be done to make it real. And people have to believe it's real. It's not just sufficient for us to say it's real. We need the regulators and the people of the countries to say we believe it's doable. Remember, it was doable in the United States for years. The FDIC took down Continental Illinois, WAMU, American savings banks, very successfully, all without damaging the American economy. So there are examples. It's just a bigger, more complex world. It's going to take a little more time to get.
But it could be done under Dodd-Frank.
I think it could be done, but it's going to take foreign jurisdictions, particularly London, working out common sets of rules and how it would take place.
Now, we also are concerned with reference to the American taxpayers being stuck. In 2009, we wanted an ex-ante fund to resolve big banks, and I think that a number of individuals, I think maybe JPMorgan Chase was against the ex-ante fund.
Gentleman's time is up. Thank you. Mr. Garrett for 5 minutes.
And I thank the chairman. Thank Mr. Dimon. So before you came here, the previous panel, I don't know if you were watching in the back room, one of the cute little analogies that Mr. Gensel used was about before he gave his keys to his daughter, he wanted to make sure that there are rules and regulations out there, and if not regulators, maybe a cop on the beat. The only problem with that, to try to compare that to this analogy, was that there was, sitting right where you were, there was 1, 2, 3, 4, 5 regulators or cops on the beat, and each one of them gave basically the same answer, is that they got to the accident scene afterwards, and in each case they were going to tell us what they're going to do next time. So the analogy really doesn't hold true, because we're trying to do, obviously, better than that. I know you gave the testimony here and back at the Senate. Your exact quote I had was, with regard to the role of the regulators and what they could and couldn't do, you said, I think you have to give the regulators realistic objectives. I don't think realistically they can stop something like this from happening. It was purely management mistake, and if we're misinformed a little bit, we're not purposely misinforming them too. You had there was 100 regulators, embedded, if you will, working full-time, getting up every day to go to your firm to work. So aren't we at a case where there's a little bit of a charade here with the American public with regard to what it is that the regulators, even after 2,300 pages of Dodd-Frank, are able to do in these circumstances, that they're really not able to get into the detail, into the granular nature of things with or without modifications to the rules?
Yeah, I think I've mentioned before, I think realistic assumptions help, realistic goals. I don't think that stopping one thing, but they can disseminate good information. They could demand best practices. They do have constant audits. They can make the system better in total, so there are fewer mistakes and far between.
Yeah.
But I would never blame them for a mistake we made. Maybe what they learned from us will stop someone else from making a similar mistake.
Now, I know that the ranking member and the ranking member of the full committee were somewhat taken aback maybe by some of your responses to Dodd-Frank and the legislation and how it's being implemented, and that's fine. And I concur and I commend you as for your part. Your part is to lobby for, if you will, the position for your firm on positions of these issues, and also something more from that as far as what's best in the interest of your investors too, I would presume, correct?
No, my highest, most important thing to me is the United States of America.
Actually,
I hope when I look back, when anything I say was in the interest of the United States of America and not in the interest of JPMorgan Chase. And I feel that JPMorgan Chase will meet all the rules, meet all the regulations, will continue to serve our clients, and that's what we're going to try to do.
And I was going to lead there with, if your answer to the first question was yes. So part of the reform that we may need in this area is what? The extraterritorial effect of some of the rules that we've had so far. And we've done that in a bipartisan manner, right? So we had a member, he's not over here right now, but Mr. Himes from Connecticut has legislation with us to try to reform it, to limit it in. But you see at the same time what? The previous panel, you had CFTC chair coming out with their proposed regulations, actually not regulations, rules, but guidance in certain of these areas, in the areas of coming up with various standards, coming up with 2 separate standards for swap and security-based swap dealers. Is that the appropriate manner that we should have? Purely guidance rules coming out where you don't do a cost-benefit analysis beforehand, or should there actually be more of a close working relationship between the CFTC and the SEC when issuing and promulgating rules in this area?
Well, the CFTC and the SEC is the primary example where we should have one set of rules around derivatives and swaps.
Okay.
We have competing sets of rules. They haven't been defined yet. And yes, of course, I think thinking through what makes sense and cost-benefit always is the right way to do it.
Okay.
It's hard for me to imagine it's better to do something better than that.
Well, you would agree that we haven't seen that, though, since Dodd-Frank has been passed as to law?
There may have been places it was done, but I'm unaware of it, yeah.
Okay. And just to close then, I thought your answer was going to be slightly different with regard to the Volcker rule when you said that things may not have been different with had the Volcker rule be fully been implemented here. I thought the answer would be, well, had the Volcker rule been law at the time, there simply would not have been trades going on because of the uncertainty, not only by the regulators, but the uncertainty by institutions such as yours is how is it actually going to be implemented and what trade is permissible, what trade is not permissible. I'll close on that.
Yeah, no, I think the most important, we're really focused on portfolio hedging, which I think is the minor part of Volcker.
Yeah.
I think it's the market making that allows these great capital markets in America to remain healthy, to finance companies at a very cheap cost to investors and issuers. That, to me, is the more important part. And there are, if I remember correctly, like 170 things written around that.
Right.
And we're concerned that that will stifle the capital markets here. If they're not done right. They may very well end up being done right. The regulators, I think a lot of them want to get them to the right place. It's just very hard to do.
Very hard to do. Thank you. I yield back.
Thank you. Mr. Capuano for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Dimon, for being here. First of all, I want to tell you that I've agreed with a lot of the statements that you've made. I know that may surprise some people, but It shouldn't, because I think, first of all, I welcome your voice in the discussion about what is appropriate regulation. There's no golden answer that any of us, at least I don't come to the table thinking I know the answer. It's, you think, you try, you talk to people like you. Does this work? Does that not work? So I welcome your voice, whether we agree or not, in the final analysis. I particularly welcome your comments on Title II of Dodd-Frank. You have clearly stated that you are not too big to fail. Is that a misinterpretation?
Nope.
I agree with you, but I wish that some of my colleagues on the other side would finally hear that, because I think we handled that in Dodd-Frank. You've stated it. I agree with you. I also fully agree with you on the simplification of regulators. I think we have too many regulators as well, and I wish that some of the large institutions, I don't remember whether you personally or your institution was, but in general, the larger institutions and the organizations were nowhere to be found when we were having this debate during Dodd-Frank. I was on the side of trying to simplify the number of regulators, not because of what they're going to regulate, because it is too many people doing the same thing. Totally agree. I would work with you or anyone else to try to reduce the number of voices at the table to make your job easier. That doesn't say that I would reduce the regulation, simply simplifying it. I do want to talk a little bit more about the extraterritoriality, because, again, I don't think that you've said anything here that I disagree with relative to competitiveness. We want to keep our financial institutions competitive, but I want to be clear. I want to make clear that I'm understanding you correctly. You're not arguing that all financial institutions, U.S. or any others, should always seek the least regulated regime. That's not your argument, is it?
That's not my argument, no.
I didn't think so, but I wanted to be clear about that. I would suggest very clearly that you're not wrong about competitiveness. It's nobody's goal, I hope, not my goal, to try to regulate you into a competitive disadvantage. And I think that that's what the world is trying to accomplish now. Basel III is a classic example. It is not the answer, but it is a step in the direction of trying to get all the different major countries around to have similar approaches towards financial institutions. There are still loopholes. Whether you take advantage of them or not, there are loopholes. They exist in London and elsewhere, which is why people are there. You may not be there for that reason. I don't know, and I really don't mind whether you are, because you're one institution. The institution of JPMorgan in and of itself is of little interest to me. What I'm interested in is the entire system and the U.S. competitive advantages that we might have. And when you have a loophole in London or any place else that people take advantage of through regulatory schemes, we need to talk about it openly to try to find out whether their regulation is better than ours, whether their regulations are worse than ours, and regardless, how we can work them together so that loopholes, not just for you, but also for your competitors, don't give them an advantage. And I would argue that very clearly, when you say that you're looking to offer the best deal, you're 100% right. You should. But the truth is, if it's only about the bottom line best deal, you'd be loaning your money on the corner of some street someplace, because they get a better deal than you do. They loan out their monies at much better rates than you get. The difference is it's a little less secure. So when you talk about best deal, it's not just bottom line, is it? It's also the ability to get those loans paid back and to make a profit. Is that an unfair? It's not just, you're not just looking at the bottom line.
I was referring to the best deal for the client. We're not going to win the business if we give them not the best deal. Right?
Exactly right. But the best deal is more than just the lowest common denominator.
Yes.
It is also security, it's stability, it's operations under the rule of law, to know what those rules are so that you know the deal you're making is the deal you're going to be able to enforce. Is that a fair way to say it?
It's true, yes.
Thank you. See, I told you, Mr. Dimon, we're not that far off from what we may have difference of opinion where we go. But I do want to talk to you about one thing that's happening today. As we speak, there's another committee meeting. It's about, well, at least the last I read, at least the news reports are reporting, they're going to cut out $25 million from the CFT's ability to pay their staff. Do you think that's a smart thing for us to be doing, to be cutting the ability of regulators to do their job?
I have never looked at the CFTC budget. We've already said, by the way, that we have a CFTC and an SEC in duplication. I would prefer we fix the duplication before we throw more money at it, but that's what I do at my company. I can create a lot more staff tomorrow, too, but it's not necessarily the right thing to do.
And I agree with you with the analysis, but in the meantime, until we get there, do you really think it's a smart idea to, with the regulatory regime that we have today, we both agree that it's not what we want, but it's what we have. Do you really think it's a smart idea to be cutting the legs out of one of those major regulators? Do you think that's good for America?
I have enough problems. I'm going to leave that to you.
Well, Mr. Dimon, the only reason I ask is because you have had no hesitancy whatsoever in expressing opinions on other matters. I thought you might want to take an opportunity to express one today.
I know nothing about their budget. I don't know how many employees they have. I really don't know. So it'd be, I try not to have comment, but I know nothing.
Well, I'd like you to learn it and maybe get back to us on the answer, because the truth is, I'd like to hear your answer before we actually vote on the floor. Thank you, Mr. Dimon.
You do know that we're in serious trouble down here on our budget, I guess. You'd rather have your budget than ours, I'm sure.
No comment.
Ms. Hayworth.
Thank you, Mr. Chairman. Mr. Dimon, I realize that the activity that we've talked about in terms of the loss for Morgan in April was bank hedging that was within the institution, but I have introduced legislation, in fact, it passed unanimously through our subcommittee and committee to repeal most of the swaps push-out, Section 716 of Dodd-Frank. It strikes me that this example of the potential risk undertaken, and there's always risk involved, and there's going to be loss from time to time, but the potential risk undertaken in these sorts of activities it would seem, perhaps highlight the need for us to keep those activities within institutions where they are more regulated, if you will. I just appreciate your comments on that.
I would agree with that. And the push-out, I never understood it. I always thought it could make things riskier, not safer.
Right.
I never understood why it was put in there at all.
Right, and we did, in fact, we have broad support for that, so I'm hopeful that we'll be able to move that through expeditiously. With regard to the fact that derivatives activity seems to be concentrated in London, I get the sense that I'm a physician. I get the sense it's because they're the specialists, so to speak. They do that kind of thing all the time. But Chairman Gensler implies that the rules are inadequate governing those activities, and yet through the G20, our regulators and extraterritorial regulators have coordinated fairly closely. Do you feel that there is a need for us? The SEC is about to come out with its ruling on extraterritorial activity. Do you feel that we need to have some sort of regulation that we apply to our subsidiaries extraterritorially?
No, I've been clear. I think that the foreign laws should apply over there so we can compete fairly over there. And it's not they were always regulated, the OCC and the Fed, so it's not true there's no regulation. There was prudential regulation at the top. And the trades that I mentioned were collateralized, 60% cleared. So I think some of those rules wouldn't have mattered at all.
Right.
And AIG, which I know keeps coming up as an example, AIG was insured only. They weren't trying to hedge anything. AIG was an insurance company. AIG didn't have regulators who understood credit derivatives. And AIG, they accounted for them as insurance contracts. They were not marked to market and for the most part not collateralized. So a completely different example in a different industry.
Right, right. And yet an enormous level of risk, obviously, that had great implications, but you cannot map that situation onto the Morgan situation, onto the JPMorgan situation. Now, clearly, sir, there have been questions about the activities of risk committees. Obviously, there are lessons that you've referred to that JPMorgan has learned. Are there lessons that we can apply to what our regulators use, the criteria they use, and they look at how our institutions undertake risk?
Yeah, so risk committees, and obviously we failed in this regard, but we have very strong risk committees. You need properly staffed, properly reported, that everyone gets it, independent-minded. Their job is to challenge management, all the way to the CEO. Why are we doing that? Why don't we have more limits? What can go wrong? Let's stress test it. And that's what those committees are supposed to do. Proper reports, granular limits, constantly testing, and protecting the management from themselves sometimes. And our risk committees do report independently. In this particular case, the risk committee made the same lack of oversight that I probably made a little bit down the line about this one activity. They had some pretty good disciplines in the other activities. It was in the synthetic credit activity that it should have been much tougher.
Yes, sir. And in terms of, obviously, JPMorgan has regulators in-house who closely monitor your activities. Is there an element of human nature that makes us to a certain extent comfortable with each other and how we do things that may lend a certain amount of hazard to these relationships over time?
No, they're not. They could be pretty tough on us, but I think what happens sometimes is, and just human nature is, I say it's okay, the next person doesn't spend that much time on it, the next person doesn't spend that much time on it, and kind of around the table, everyone says it's okay.
Because you have a track record.
Yeah, all of us. So you can't be complacent about risk. It has to go through a rigor. It's not whether you trust the person, because I trust a lot of people,
Sure.
is that it's got to be independently verified.
Right. Trust but verify. Thank you, sir, and thank you, Chairman. I yield back.
Thank you. Mr. Hinojosa, 5 minutes.
Mr. Dimon, thank you for your testimony. The recent JPMorgan loss comes at a time when we have many in your industry complaining about the new regulations that were put in place with the Dodd-Frank Wall Street Reform Act. For good reason, the $2 billion plus loss has pressed the pause button on the constant stream of attempted rollbacks to Dodd-Frank. It seems to me that with the recent conviction of a prominent Wall Street corporate director, Wall Street firms do not seem to be going out of their way to restore trust with the American people. I understand that JPMorgan will still turn a profit this year, but the size of the loss and the complexity of the trades and macro hedging that caused the loss still gives cause for concern. There needs to be an evaluation of not only prudent regulations, but also the broken culture on Wall Street, a culture that some believe provides perverse incentives to play fast and loose with other people's money. After the crisis, there should have been major self-reflection and re-evaluation of Wall Street. Mr. Dimon, looking back at this loss, do you feel that the compensation structure at JPMorgan might have created incentives for excessive risk?
I don't agree with what you said about Wall Street, so I'll be direct about it. I think there are a lot of people you can trust on Wall Street. There are a lot of people you can trust anywhere, and I think when anyone blankets a whole industry with the same thing, I think we're making a mistake. It's like when people blanket all of Congress the same way. I just think it's not fair. We try to have a culture of the company where people have long-term careers. They aren't paid just because of profits. They're paid because they're good managers. They're paid because they recruit, they retain, they're open-minded, they're independent on risk committees. They participate in the company. They mentor younger people. That's what we do. It's not just financial results that drive people's compensation at JPMorgan. And no one in this area had formulas. Now, is it possible that someone here says, yeah, I was driven a lot by money? Well, yeah, people, that shouldn't be a great surprise to you or anybody else. Some people are driven a lot by money. Some are not.
Next question. Do you feel there's a problem with Wall Street culture?
I think there might be a problem with some people on Wall Street. And, Wall Street, for the most part, are honest, decent, hardworking people. Their clients trust them. And to the extent we lose it, we should earn it back. I think if you talk to most of our clients, they think that JPMorgan tries to do a very good job for them, including when we make a mistake, we admit it. We try to rectify it. And all firms are different, so I can't speak for every firm while I'm standing here.
Mr. Dimon, what would you personally recommend be done by Congress to strengthen the Dodd-Frank Act so that we can prevent actions with the complexity of trades and risky derivatives and macro hedging that cost the loss of at least $2 billion at JPMorgan, which brought us to this congressional hearing? We want to ensure similar losses occur that do not occur in other banks, and I'd like to hear your recommendations.
I have lost this argument publicly many times, but I'll make it again. Regulation is not binary. It's not left or right. It's not Democrats, Republican. These are complex things that should be done the right way, in my opinion, closed rooms. I don't think you make a lot of progress in an open hearing like this. Talking about what works, what doesn't work, and collaborating with the business who has to conduct it. We want a safer system, too. We have as much of a vested interest in having a safe and good financial system as anybody else, and we'll do anything we can to be part of a process to make it healthy and safe. I should point out, it is a lot healthier and safer today. The market did a lot of things, like I mentioned, no off-balance sheet vehicles, no subprime mortgages, no No exotic derivatives are going away. Regulation has created more capital, more liquidity. Standardized derivatives go to clearinghouse. It is a much stronger system today. A lot has been accomplished.
My time has ended, and I yield back.
Thank you. Mr. McHenry for 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, there's this discussion today, the distinction between hedging and proprietary trading. Can you define to us the difference between, in your view, of hedging versus proprietary trading?
But I'll tell you what I think. A hedge is meant to protect you that if something goes wrong in a decision you make. Proprietary trading, I think people mean is just making a bet that prices change and you can make money in a price change. The problem with that is every time we make a loan, it's proprietary. The riskiest thing we do is loans. They're all proprietary. If we lose money on them, and one of the congressmen mentioned how much money we can lose on loans, that's to the house account. We still make them. We try to do the right thing to risk manage it. I understand and never disputed the intent of the Volcker Rule, to make companies safer. I totally agree. I think we've made something very complex, which is going to be very hard to legislate or put in regulatory terms that works.
Is there a bright line distinction between hedging and proprietary trading? Because don't they look similar unless there is a balanced trade on the other side that matches up?
I think in some cases there's a bright line, yes.
Okay. And how long have you been in finance? How many years?
A long time.
Okay.
30 years or so.
We'll just say a long time.
Yeah.
And for a living, you're supposed to know the distinction between this. You're testifying before Congress. You've obviously spent a lot of time doing this. So is there a bright line distinction between that? And if you can't determine what that is, how can a regulator determine that?
I wouldn't have set it up proprietary versus hedging. That's not how I would have had the conversation. If you wanted to make the system safer, I would have said for trading, proper capital, proper liquidity, make sure it's largely done with clients, you look at aged inventory, you have proper risk reporting, you do have the ability to portfolio hedge and hedge because you need that in trading, and you can track all of these things to say if you're running a good customer business or not. It does not eliminate risk, it'll mitigate the risk.
Okay, so did you support Dodd-Frank?
That's a hard one to say. We had a major crisis.
Did you support Dodd-Frank in its inception?
We had a major crisis, and we never denied that. And the crisis unveiled lots of flaws in our system. Not one flaw, lots of flaws. So we understood the need for reform. There are parts of Dodd-Frank we supported. There are parts of Dodd-Frank we didn't.
Okay.
You do remember there are lots of parts of Dodd-Frank. So it's not like we had the same vote.
Suffice it to say, you've got a little buyer's remorse. That's kind of what I'm hearing. So, I understand you're basically saying, yes, you understand the need for changes. You just don't like the result.
Some of the result.
Some. Okay.
Some should be modified.
Okay. So with Volcker, as it's being written, the distinction between, proprietary trading and hedging, that is a bit of the debate that's going on right now. So, look, my concern is in the post-TARP era, when we said we're going to end bailouts, we've actually codified it and institutionalized it. Therefore, when a company like yours that received extraordinary support from the government has a trading loss, the government gets very involved. Why is the government very involved? Well, because we've institutionalized too big to fail and bailouts with Dodd-Frank. Now, to that point, during your hearing last week with the Senate, you discussed the distinction between a resolution authority and bankruptcy. Would you touch on that? Would you explain your view on what is preferable, the resolution authority as written in Dodd-Frank or bankruptcy?
Again, there's a lot of semantics. I would use the word bankruptcy. A bankruptcy implies that the equity gets wiped out, the unsecured debt only recovers as some leftover recover, and a court manages the wind down of the company. You do need an expert like the FDIC to manage the process. That's got the right people, the right structures, the right capabilities to manage the wind down. And that it should be wound down and all clawbacks evoked, board of directors fired, the company should eventually be dismantled in a way that does not damage the economy, the name should be buried in disgrace. That's what should happen.
Okay, so that's called bankruptcy, right?
You guys can call whatever you want. I'm not going to get involved in the debate between bankruptcy and
Well,
resolution.
you're involved in the debate, actually, sir. I don't know if you've been here for as long as, anyway. But the distinction between resolution authority, which is in essence codifying too big to fail, in essence codifying the fact the government will lift you up if you fail. Therefore, these trading risks can be as risky as possible. This is the crux of the debate and why you're here today.
Well, they won't lift you up. They'll keep it going, but the equity's wiped out, management's wiped out, unsecured's wiped out, company gets demanded, and eventually it's not there without damaging the economy.
So we'll put you on
Your
record
time
as
is up,
supportive of that.
Mr. McHenry, thank you. Mr. Miller for 5 minutes.
Thank you, Mr. Chairman. Mr. Dimon, you were very dismissive last week with the Senate about a Bloomberg article. I think you told the Senate committee not to believe everything they read that said that the CIO had really changed in the last few years from being a fairly sleepy, cautious risk mitigation unit and had become much more aggressive, much more risk tolerant and profitable. And it was your intention that it become a profit center, and in fact, more than a quarter of JPMC's profits for 2010 came from CIO's trading. But there was a question that Senator Johnson asked you from that article about that there had been a limit that traders had to liquidate, had to get out of any position that had lost $20 million, and you were very puzzled by that and said you knew nothing about it. Have you inquired since then if there was such a limit and it was changed?
No.
You have not asked within your organization?
I think it was referred to something back in 07 or 08, so I did not ask, no.
All right. You did say last week that the failure with these trades was not that it was rogue traders. They weren't violating the risk controls. The risk control that were not sufficient. That is correct, right?
They were too low. They were too high. They should have been much more lower limits that they had, yes.
Well, did they have any limits? Last week you seemed to indicate not.
No, the CIO as a total had limits, but this unit didn't have its own, but they used the CIO's limits, which they eventually helped hit, which stopped it at this level of loss, yeah.
But a limit of $20 million in losses and then you close the position, that would be a fairly granular risk control, wouldn't it?
If that were true, it depends what the area is, but yes.
All right, and you have been very critical of JPMC in this matter, and you said that it was a significant risk management failure, said it was flawed, complex, poorly reviewed, poorly executed, poorly managed. But on February 29, you filed a certification required by law that you had adequate risk controls in place, that management's assessment, the firms determined that there were no material weaknesses in its internal controls over financial reporting as of December 31, 2011. I know that you're entitled to rely upon your subordinates, and I'm sure you relied upon your subordinates in making that certification, but was that certification correct?
I believe it to be, yes.
It was correct?
It was to my knowledge at the time, and
Well, no. Not based upon your knowledge of the time, but based upon what you know now. Was that certification correct?
That's why we're having a review, to make sure that we've got all the right things in place. That's what companies do when they have problems. They analyze them, they review them, and they make determinations like that, and the review's not done yet.
All right. Who is entitled to, I mean, it seems like that certification is intended for regulators. It's also intended for investors, isn't it? Aren't they entitled to rely upon the representation that there are adequate risk controls?
I don't know the thing you have in front of you, but...
What's that?
I don't know what you're referring to, but we try to give proper disclosures to our investors.
Well, I'm referring actually to the certification about risk controls.
Yeah.
The certification is required by law, and presumably it's for both regulators and also for investors, isn't it?
Yeah, we try to disclose what we're supposed to disclose.
All right. What inquiry did you make about risk controls at CIO before you signed that certification?
I believed at that time that the risk controls in CIO were properly being done. That they were properly being done.
You were surprised last week at the question about the $20 million limit. It appeared to be something you were hearing for the first time, and you haven't inquired in the 6 days since then whether that was true. I know that you're entitled to rely upon your subordinates. You said that last week. But it seems like there must be a limitation on that entitlement if you have noticed that there may be something wrong. And one of the ways that you might get in other information would be from the financial press. Did you read the Bloomberg article?
I don't remember I read the Bloomberg article.
Well, it was an article that said there was a $100 million limitation that traders at the CIO had to close positions once they'd lost $20 million. And that would seem like that would stick out as a pretty big deal.
It wouldn't stick out to me. It happened many years ago. I would pay virtually no attention to it. I'm sorry.
Thank you. Ms. Miller, your time has expired. Mr. Stivers for 5 minutes.
Thank you, Mr. Chairman, and thanks for being here today, Mr. Dimon. Before you were seated, we had a first panel where we had 5 regulators, and the 2 things that really struck me out of that panel were something Mr. Alvarez from the Federal Reserve said about capital. Obviously, that's a theme we've had here today about how capital, your strong capital position saved this from causing JPMorgan to have a big problem and ensures that it won't cause the rest of the system a problem. The other thing was Mr. Gruenberg from the FDIC talked about risk management. That's your questions that you got from Mr. Grimm and Ms. Hayworth centered around risk management. Is there anything in your internal review other than capital and risk management that have come out that are lessons learned that other institutions should know?
Well, I think you've all brought up some things a little bit about models and implementation of models, making sure risk committee is independent-minded, not just sitting around having a cup of coffee. All those kind of things. So there'll be more than just that. But
yes, sir. And Mr. Frank talked a little bit about smart regulation that you'd referred to earlier. We had those 5 regulators sitting in the seats before you. Not one of them really is in charge of the others. They don't really coordinate. There were a lot of questions about how they share communication. In fact, no questions came up from any of the previous panel about harmonizing the regulations between Europe that they passed in on March 29th with the U.S. regulations, and there don't appear to be any lessons learned that are shared with other firms after what you go through to make sure that there's real shared knowledge. Do you want to comment any more about what smart regulation means to you?
So when Dodd-Frank was done, one of the things it had was the FSOC, like an oversight committee to make sure no gaps in the system and the learnings are shared, and we kind of supported that, but it was set up with, I say, virtually no teeth. And the legislators would have to change it, but someone should tell who's responsible for mortgages, who's responsible for Volcker, as opposed to 5 people that have jurisdiction. You see how complex it gets, how long it takes to work it out with foreign regulators. So I think simplifying it, clarifying it, adjudicating disputes, and giving authority and responsibility to the same people would be a good thing.
Do you want to comment a little bit about how the impact on a multinational financial firm like yourself with regulations in Europe and regulations here that are not harmonized?
Yeah, well, so we talk about Dodd-Frank, which has 400 rules. We have to accommodate Basel, which has hundreds of different things we have to do. We're not against them all, but liquidity, capital, et cetera. But the rules come in out of Brussels, FSA, which is in the UK, and several others. So, and CFTC, SEC. So we have to deal with a lot, and we're going to. I just wish it was a little bit more coordinated and we dealt with the important ones first and not just treat everyone like they're all the same, like they're equally important. Yeah. To a hammer, everything's a nail, and that's what we're kind of doing.
And some questions have come up earlier today, and I'm going to make a statement instead of asking you this, but there have been a lot of questions about too big to fail, and I'll just say as a policymaker, too big to fail only happens when policymakers let it happen. So I'm not asking you to comment on that, but that's a fact. I do want to talk to you about the Volcker rule a little bit. You've had some questions about it before, but it really, the key thing on the Volcker rule will be getting it right. I mean, I don't want financial institutions that can run to the Fed funds window borrowing money and then putting it in a trading account and essentially gambling with it.
And we don't.
But at the same time, you have to be able to hedge your positions. So I hope that we can work with the regulators as policymakers here and with the industry to craft something that makes sense. And if you have any ideas for us, I got a minute and 4 seconds. I'll let you tell us if you have any ideas on how to make that happen.
The only idea I have is that people should actually get in a room, talk about what we're trying to accomplish, go through the specifics, and not pretend that it's either for Volcker or against Volcker. It is, for us, it's the law of the land. You all may want to get rid of it, but we have to deal with it, and it's a very detailed thing. And I remind people, we do have the best capital markets in the world. You should go home at night and say that we sit upon the best economy of the world, the best capital markets of the world, the best job creator of the world. We need to start doing jobs again. And we need to fix the mortgage market. We need to do a lot of things. If we do it, I think we'll help this economy recover quicker, not slower.
One of the things Mr. Kinsler said earlier today, that there weren't many things he said that I agreed with, but the one thing he did talk about is the advantage Europe has as being in a time zone between Asia and the U.S. And there have been a lot of questions about why certain trades go to London. And I know you need to follow your customers who are global too, but isn't there some advantage to that time zone?
Thank you. And Ms. Stivers, your time is up. I think the answer was yes. Maybe.
Yes, yes.
Mr. Scott, for 5.
Thank you, Mr. Chairman. Welcome, Mr. Dimon. Good to have you. I want to start off by paying you and your operation down in Georgia a tremendous compliment. Georgia's #1 in home foreclosures. And we had a great home foreclosure event down there, and I want you to say a good word for your folks down there in Georgia, Mr. David Balo and Todd Williamson, Vanessa Mims, your Chase Home Ownership Center. Good job. We saved over 1,785 homes, many of them yours, so good work. Let me just wait for a moment, because I think it's very important for us to set the stage here. I think that we in the United States of America and probably the world economy dodged a bullet. And we dodged a bullet basically because of your size, because of your largeness. You were able to handle and absorb this loss. But there's much we can learn from it. And I think that if I get my hands around this correctly, one was not enough attention was paid early on in the game. Is that correct? Would you say that's one of the major reasons why the loss was substantial?
In hindsight, yes.
And your reporting was diluted in the aggregate, which caused a problem as well. The fundamental issue here, so we can learn from the future, is your risk management tool is referred to as value at risk. That was your model. And it is one of the reasons it was used to effectiveness, but it's basically predicated on a large financial institution. You are the largest financial institution in the world, certainly in the United States of America. And that's why you're still profitable. Taxpayers didn't lose anything on this, and it was effective. But here's the question. What would smaller firms have been able to have those same protections using the same risk at value model as Chase?
So we use lots of protections. VAR is like one of many things we do to manage risk. And I should point out that there are reasons for big banks, there are reasons for small banks. Community banks do a great job. And JPMorgan Chase, in fact, is one of the biggest banker to banks. The history of JPMorgan was, as a money center bank, was to bank banks. And I think some of them can, yes. And I can't go through each one. They have different business models, but each one should do what they need for their own business.
Okay.
They're not the same businesses we're in.
Let me ask you this, Mr. Morgan. As a result of this, should one of the things we do now, should banking entities like Chase Morgan Bank, JP Morgan Bank, be allowed by our regulators to hedge only on position-specific basis as opposed to on an aggregate or portfolio basis?
So if I were the regulator, I allow portfolio aggregate. I'm going to give you one example, because several people have mentioned Europe today. So JP Morgan's been doing banking in Europe for 75 years. JP Morgan himself used to love Italy and would go there. We have exposures to Italian companies that you can't get out of tomorrow. So if you were on my board of directors and you said, I don't want Italian exposure, well, there's only one way to really do it. It would be to go and do certain portfolio hedging, which would accomplish part or all of that. If you said do it by individual name, it would be impossible.
And Mr. Dimon, I think the American people would want to know, when this happened, when you first got wind of this $2 billion loss, what was your initial reaction?
When I fully realized it, I told our people that everything is going to happen from coming down to Washington to questioning Volcker, that I think we've heard other bankers. It causes a lot of commotion inside the company, soul searching. But my attitude is, let's admit our mistakes, fix them, let's put our jerseys on and fix it, that we'd have to make changes. This would be a very tough time for us. However, it does affect it, but it shouldn't distract us from our mission of serving clients. We have 82 Chase home offices. We've opened them all in the last 3 or 4 years, and we'll do all the things we have to do to serve the clients right. And I don't want this detracting from what all of our 260,000 people do every day.
Right. And I can't let you leave without this question, because the fundamental question going forward is this whole issue of too big to fail. How do you feel about that, especially since you are the biggest of the biggest?
So our goal is not to be the biggest, it's to be the best. I think everyone kind of agrees we have to get rid of that in any incarnation. There are multiple.
You said get rid of too big to fail.
We cannot have too big to fail. We have to eliminate too big to fail, therefore allowing a big bank to fail in a way that doesn't damage the American economy and the taxpayer never pays. And I think we're on our way to working through the things that would allow it to take place.
All right, thank you.
Thank you, Mr.
Mr. Neugebauer for 2 minutes, and that will then conclude our hearing.
Thank you, Mr. Chairman. Mr. Dimon, I want to just kind of go through a little calendar here. On April 6th, Bloomberg had an article. You're familiar with that article?
Yes.
And I think the Wall Street Journal had an article that same day. Then, were you aware that the regulators had come into your shop on April 9th and had expressed concerns about this article and the trades?
I'm aware that, I don't know if they came or we called them. Like I said, we share everything with them. So I do believe some of our people spoke to regulators and described to them what they thought about it, yes.
So it's reported on then Tuesday, April the 10th, that that particular position lost $300 million that day, and then I think subsequently on the next Tuesday and Wednesday with smaller losses. Were you familiar with those?
Yes.
And so then on April 13th, then you made a statement that it's no big deal, it's just a tempest in a teapot. Was that an accurate reflection of that transaction?
It's totally a positive, accurate reflection of what I believed at the time, because folks had done work to look at the additional stress. That day that lost $300 million was the first trading day after the article, so part of that was expected since we just showed the world our hand a little bit. The stress test has showed that it could be that dramatic. Several people believed that, reported that back to me. So on April 13th, I believed it was a tempest in a teapot. I obviously was dead wrong. It won't be the first time I've ever been wrong. It won't be the last. I obviously was dead wrong. I deeply regret having said it.
Yeah, well, I understand. I think that the concern I had was that, that was a couple of days after, that $300 million pop. And that's a pretty big pop even in your organization, isn't it?
Our folks have looked at reports after that about how bad it can get. We stress tested some of the stress reports. I may have seen them, but they reported to me that doesn't show it could be that much worse. So no, if that's what we believed, I would have considered that a small thing for JPMorgan.
Thank you.
We're going to have a very profitable quarter. You got to put things in relative size.
Thank you. Thank you, Mr. Neugebauer. Mr. Green for 2 minutes.
Thank you, Mr. Chairman. I'll be quick. Mr. Dimon, thank you for appearing today. Is it fair to say that you've probably had more than 50 meetings concerning this issue that we're talking about today?
50 what?
50 meeting with people talking on the phone about this?
Yes.
Probably 100.
More.
More than 100. And is it fair to say that you are amenable to meeting with and talking to various people about these things and other things associated with your business, and that probably you meet with congresspersons and talk to them about these issues?
I talk to people if appropriate. We operate under a lot of rules and laws of what I can and can't say to certain people.
But if appropriate, do you meet with congresspeople?
It's on occasion, yes.
Okay. I'm asking this because I want to talk to you about a concept that is near and dear to my heart. We've been talking about too big to fail. I want to talk to you about a concept that I have called too small to live off. That concerns something that is happening in this country. We have in Houston, Texas, some persons who are janitors, and they are paid $8.35 an hour. Now, I know this is very small compared to what we've been talking about. I think you've made about $19 billion in 2011, thereabout. Is that right?
Yes.
Okay. And I understand that your fourth highest paid person makes about $14 million, made about $14 million in 2011. I won't mention the name, but there's a reason for picking the fourth highest. With persons making this kind of money, and by the way, I salute you for it. I am a capitalist. I commend people for making the money that they make within the rules, of course. But what I want to talk to you about is this. $47,000 is what it costs a family of 4 to live off in Houston. The poverty level is $23,000 a year. The average janitor working full-time will make about $18,000 a year. That's working full-time and living below the poverty line. I'd like to meet with you and talk to you about too small to live off. And I'll pay my way. I won't use congressional funds. I'll be willing to do it any place that you'd like. Can you and I meet and talk about too small to live off, Mr. Dimon?
Yes, we can.
Thank you.
I'll be honored to do it. I'll talk to you after the meeting. Thank you.
Well, actually, you know, or maybe tomorrow, the next day, or within the next 30.
No, I'm going to miss the vote.
Thank you. This concludes the hearing. The chair thanks our panelist for his testimony. The chair notes that some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will be held open for 30 minutes for members to submit written questions to those witnesses and to place their responses in the record. This hearing is adjourned. Thank you.
Help her right. Thank you very much, Mr. Chairman.
The hearing has been adjourned, and let's file out, okay? Oh.